My name is Diana Shepard, and I'm editorial director of Divorce Magazine. My guest today is Manhattan tax and financial expert John Johansen, and he's here to discuss what divorcing individuals need to know about the CARES Act. A certified public accountant, certified financial planner, and accredited in business valuation, John has a niche specialization in helping divorcing individuals and their lawyers work through the business valuation, tax, and financial issues of divorce. Welcome, John, and thanks for being here with us today.
Well, thank you for having me, Diana. It's my pleasure.
So let's dive right in. What are the key points of the stimulus bill known as the Coronavirus Aid, Relief, and Economic Security Act, otherwise known as CARES, that a divorcing couple should be aware of?
Well, if the divorcing couple, if one of the parties owns a business, they should be aware, excuse me, of the two primary loan programs that were created as part of CARES. The first of those loan programs is referred to as the Payroll Protection Plan, and just sometimes it's abbreviated PPP. And just as the name applies, the government's goal with that program was to help employers keep their employees either on the payroll or to bring them back if they were laid off or furloughed. This program is a forgivable loan program as long as 75% of the funds are used for payroll costs, including not only wages, but health benefits and retirement benefits. The other 25% can be used for rent, utilities, and mortgage interest. So that should be something that divorce attorneys and their clients should be aware of. The other loan program is called the EIDL program, Economic Injury Disaster Loan. Those are true loans. They're low interest loans at 3.75%. They have a 30-year payback period. And they can basically be used for any types of business expenses. They're not only limited to payroll. So those are the two loan programs. In addition to the loan programs, there are many tax changes that affect not only businesses, but individuals as well. The one that affects individuals, so divorce attorneys right now that may be scrambling or trying to settle cases where maybe one of the couples is experiencing an economic difficulty and needs to settle the case. There were three changes made to retirement plans for individuals. So the first change is that there will be no required minimum distributions from required retirement plans. This primarily affects taxpayers that are over the age of 72. So kind of that graying divorce area would be affected by this. But you should be aware that those people will not have to make required minimum distribution this year. In addition to that, for younger divorcing individuals, for those under 59 and a half, there would normally be a 10% penalty, an early withdrawal penalty on monies taken out of a retirement plan. This year, they will be able to take that money out of retirement plan up to $100,000 and not pay the 10% penalty. So on $100,000, that's a savings of $10,000. In addition to that, normally that money would be taxable in 2020. Under this program, you can defer those taxes for up to 3 years. It's a third each year for the next 3 years. But you also get the option to replace the funds, and if you replace the funds within that 3-year period, then it become non-taxable. So the other that would allow divorcing couples to find cash to settle their divorce cases in 2020. The other tax changes that affect businesses was changes to the net operating loss rules, where a business that has a net operating loss on its books that was generated in 18, 19, or 20 can carry that loss back up to 5 years. So that's a big change, because up to now, they were only able to carry that forward. They were not able to carry that back. So what they could do is if they have a profitable year in, let's say, 17, they can take the loss from 18 and carry it back to 17, or the loss from 19 and carry it back up to 5 years. They can go back. And that would produce a refund because they're reducing their taxable income for those years and thereby reducing their taxes that they've already paid. The other two changes was the reduce of the cap on business losses that an individual can take on their tax return. A married couple was only used to be only able to take up to $500,000. Now there's no limit, and other individuals were only able to take $250,000, and now that limit has been removed for the years 18, 19, and 20. Again, you would need to go back and amend those returns to produce those changes. There's also a change to the limit on business interest. That's business interest on business debt. Normally, that's capped at 30% of taxable income. That's been increased to 50% of taxable income. The other big one that we hear a lot in the news about restaurants and how they're going to suffer. And I heard a statistic that one of the restaurant industry people think that only 1 in 5 restaurants will reopen and survive. So there was a change to the leasehold improvement rules. Leasehold improvements are improvements that people who rent properties make to that property, which restaurants usually are in that category. Prior to the CARES changes, those improvements had to be depreciated over 39 years. So you got a very small taxable depreciation expense for taxes. Currently, they changed that to 15 years. So any property that has under a 20-year life is eligible for bonus depreciation, which means you have the option to either depreciate that over the 15-year period, or you can take 100% in the first year. This would affect tax years 18, 19, and 20. That change is a permanent change because it's a technical correction act, so it'll affect future years as well. But you can see if a restaurant spent $500,000 to improve that property, they can go back and take that $500,000 expense all in 1 year. So it could produce a tremendous amount of a refund.
So how has COVID-19 affected business valuations for people who are currently going through divorce? I can see that on one side, the non-business owner would definitely want the valuation to have happened before COVID-19, and the business owner would definitely want it to happen after, to take into account the last few months. Now, what the valuation sits at, of course, will affect not just property division, but spousal support and child support. So both sides are going to be equally invested in having a different business valuation, I presume. What are you doing? What's happening?
What's happening? Well, that's a good question, Diana, because in business valuation, we have a rule that facts known and knowable on the date of valuation are the only facts that you're supposed to take into account in doing that valuation. So in your example, if we had a valuation date of January 31st, we're still working on that valuation, and now we know what's happened to this business after January 31st. We're not really, from a business valuation perspective, supposed to take those facts into account. So I think what it's going to boil down to is the attorneys are going to need to get together and maybe negotiate a little bit. There probably will be, there definitely will be some court cases going forward that will address this issue. But it's going to be an interesting times. Interesting times because we've never had a situation like this before, where it's affected such a broad band of businesses. So to answer your question, I think we need to see how that develops. But from my perspective as a valuation analyst, I'm not allowed to take this information into account if I wasn't able to know it on the date of valuation.
My guest today has been Manhattan tax and financial expert John E. Johansen, who has a niche specialization in working with divorcing individuals and matrimonial attorneys in the areas of forensic accounting, business valuation, and tax. John, thank you so much for taking the time to be with us and answer these questions today.
Oh, it was my pleasure. Thank you very much for having me.